In May of 2014, the FASB and ISB issued their joint standard on revenue recognition. The standard supersedes all industry-specific revenue recognition guidance, and while some industries may be more impacted than others, all industries will need to evaluate the impacts. Today's podcast will provide you with a high-level summary of the new revenue standard and some impacts the standard may have on companies that operate in the oil and gas industry. My name is Brian Schilb, and with me today is Arturas Spencer III. We are both on the Revenue Project team in KPMG's Department of Professional Practice, although Arturas comes to us from Houston, Texas, which makes him qualified to talk about oil and gas. So Arturas, why don't you start by giving us an overview of the standard?
Sure thing. So the core principle behind the revenue standard is that an entity should recognize revenue to depict the transfer of promised goods or services to a customer in an amount that reflects the consideration to which an entity expects to be entitled in exchange for those goods or services. The standards establish a 5-step model for implementing the core principle. The first step is to identify the contract with the customer. Second, you want to identify the performance obligations in the contract. Third, you'll determine the transaction price. Fourth, you'll then allocate that transaction price to the performance obligations. And step 5 is to recognize revenue when or as an entity satisfies a performance obligation. So it's important to note that while we're not going to go through each one of these steps in detail, for the purposes of this podcast, each step can be very involved in practice, which may sometimes lead to unforeseen consequences. So while it's not generally expected that companies operating in the oil and gas industry will see significant changes in the amount of revenue recognized, there may be a few items which will impact companies within this industry. The first item is for collaborative arrangements for oil and gas producers. So collaborative arrangements and other contracts with joint interest partners are outside the scope or could potentially be outside the scope of the new standard. And this evaluation would depend on whether or not that partner meets the definition of a contract with the customer under the standard.
So Arturas, first of all, can you give me an example of what a collaborative arrangement is?
Yeah, so a collaborative arrangement might be where two oil and gas producers enter into an arrangement whereby they share the risks and rewards of owning a specific well.
Okay, and then you mentioned in order to account for these transactions as revenue, it really needs to be with a customer. So the counterparty needs to be a customer. Does the new standard indicate what a customer is?
Yeah, so under the new standard, a customer is a party that has contracted with an entity to obtain the goods or services that are the output of that entity's ordinary activities. So the second issue relates to gas imbalances. So gas imbalances arise when the amount of natural gas sold by one owner differs from its working interest. Currently, gas imbalances are accounted for in one of two ways. The sales method, where the working interest owner records revenue only when gas is produced or sold on that owner's behalf. Or the entitlements method, where the working interest owner records revenue based on its entitled portion of total monthly production. So under the SEC's current guidance, both of these methods are accepted. However, the entitlements method was not consistent or is not expected to be consistent with the new standard.
So when you say it's not consistent, does that mean that the SEC has plans to revise its guidance?
Well, at this time, it's unclear whether the SEC is going to revise its guidance. I know they've paid close attention to the revenue standard as it was being developed, but this time it's unclear what they're going to do.
Okay, so we'll stay tuned for that.
So the third issue relates to take-or-pay arrangements. So as you may know, take-or-pay arrangements are currently accounted for under 932-605 under the existing guidance. Under the new standard, determining the transaction price for a take-or-pay arrangement may be a very involved process that depends on the timing of deliveries and consideration of the time value of money. So the existing guidance, as I mentioned, for take-or-pay arrangements, which is in 932-605, will be superseded. The fourth item is that goods or services may represent a lease for oilfield service companies. So under the new standard, oilfield service companies will need to evaluate whether the goods and services promised in their contracts represent a lease, a service to be provided, or a combination of the two. If a contract contains a lease, first, the entity will separate that lease and apply the lease guidance to the leasing portion of the contract, and then to the remaining service portion, they would account for that under the new revenue standard.
And just to be clear, the new revenue standard isn't going to change the evaluation about whether or not an oil field service contract represents a lease, you'll still be required to look at the leasing guidance first and first determine whether or not your contract contains a lease. If not, only then will you apply the revenue guidance. Is that right, Arturus?
That's right. So this is mainly an issue for drilling contractors, where they may provide a drilling rig to a customer, to one of their customers, to assist in drilling an offshore or an onshore well. In that evaluation, currently, most of those contractors would not consider these arrangements to be leases, but under the new standard, they would have to go through this analysis nonetheless. The next issue is that it is really related to the timing of revenue recognition for oil and gas companies. So under the new standard, revenue will be recognized either at a point in time or over time. Oilfield services companies that are involved in manufacturing and construction will need to determine whether they should recognize revenue at a point in time or whether they should recognize revenue over time.
And how do they go about making this determination?
So, like any other company, an entity will need to consider step 5 of the model. And step 5 of the model really provides you with criteria to determine whether revenue should be recognized over time. So if you meet any of the criteria in step 5, then you'll recognize revenue over time. If not, you'll need to evaluate that point in time when you should recognize revenue.
Right, and so if these oil field service companies are performing services similar to what a long-term contractor would do, and perhaps today they apply percentage of completion accounting, they would look at the criteria in the new revenue standard, and perhaps they might meet one or two of those criteria. But as you mentioned, all you have to do is meet one, and if you meet one of those, then you're over time, right?
That's right. And I would add that specifically for those oilfield service companies that are involved in construction, will really have to look at this evaluation. Most of the companies in the oilfield services industry that, providing some type of construction service and they're looking at percentage of completion accounting today will likely be in that overtime revenue recognition model. So the last item I'll touch on really is related to drilling contractors. And so drilling contractors often enter into contracts to provide a variety of goods and services to the customer. So what they'll need to do under the new standard is to determine whether those various goods or services promised in their contracts are distinct and represent separate performance obligations, or whether those goods and services should be bundled together into a single performance obligation.
All right, thanks, Arturus. In terms of the effective date of the new standard, the standard is effective for public business entities and certain not-for-profit entities starting in annual periods beginning after December 15th, 2016. So in other words, 1/1/17 for a calendar year-end public business entity, and under U.S. GAAP early adoption is not permitted. And then for all other entities, so generally non-public entities, there's a 1-year deferral, so we'll see those companies adopting generally in 2018 with a 2-year deferral for interim periods. And those companies have the option of adopting at the same time as public business entities, but no earlier than that. So can you touch briefly, Arturus, on the disclosure requirements?
Sure. So, as I mentioned earlier, it's not expected that companies operating in this industry should see significant changes as a result of the new revenue standard. However, one exception relates to disclosures. Now, this is an area where even companies within this industry should expect there to be some significant changes. And under the new standard, the disclosures are going to expand significantly. There's going to be quantitative disclosures that are going to be required quarterly, including the disaggregation of revenue, information about contract balances, contract costs, and the transaction price allocated to the remaining performance obligations. There will also be several qualitative disclosures. And so as companies start thinking about their systems, processes, and controls, they should also consider what information is necessary to meet all the disclosure requirements. Next on transition approaches. Under the new standard, there's 3 transition approaches. The full retrospective, where you will recast all prior years presented. And then there's the retrospective, using one or more practical expedients. And one example of that might be where you don't have to recast contracts that begin and end in the same annual period. The third approach is the cumulative effect at the date of adoption, or the cumulative effect approach. Under this approach, you'll record a cumulative effect adjustment at the beginning of the year of adoption. You would also be required to provide disclosures in the period of adoption that outline the impact of the change on each financial statement non-item, and you would also be required to account for the revenue transactions under both the new standard and the legacy GAAP in the year of adoption in order to determine the effect of accounting change.
Thanks, Arturus, and thanks to you, the listener, for listening to our podcast today. For additional information, refer to KPMG's Financial Reporting Network, including the latest on the revenue recognition page, which links to KPMG analysis of the new standard, including defining issues, webcasts, and other podcasts.